Hey everybody, thanks for joining me today. My name is Jason Fieber. I'm the founder and publisher of Mr. Free at 33. I'm the founder of Dividend Mantra, and of course I write the Undervalued Dividend Growth Stock of the Week articles for Daily Trade Alert. And so this is a series we started a little while ago, and we're doing another video today. And what I do is I go over one of the recent Undervalued Dividend Growth Stock of the Week articles that I've recently written over the past month. I pick one of them. So we're near the end of June 2017 right now, and so I'm taking a look at the articles I've written for June. I write an article each Sunday, so I cover an undervalued dividend growth stock of the week each Sunday for that week, basically saying that, hey, this looks like an appealing long-term investment idea based on the quality of the company, the fundamentals, and the overall valuation at the bottom. So so this month I'm going to go up to the Daily Trade Alert. When you go to the main site here, under the Dividend Growth Investing tab, you can find all of the Undervalued Dividend Growth Stock of the Week articles by clicking on that top tab there. And you can see here for June, I've got Disney, L Brands, Cisco, and Nike. And for today's video, I chose to go over Disney. So I've got some tabs opened up so that way you guys can kind of follow along as you're watching the video and kind of see what I'm looking at, where I got my information from, how I came about my conclusion. And so again, these videos, as we've talked about in the last couple videos, this series of videos, what it's designed to do is basically complement the articles and add value to the articles and kind of cement some of the ideas and kind of provide more concrete for the foundation. Where did Jason come about with these numbers? How did he get, where did he come from with this conclusion? Where's everything coming from? And so these videos provide some background information and kind of go through and explain a little more, for anybody who's maybe new to the series or new to investing or even more advanced or experienced investors. We try to provide a little more value for the articles, and that's what these videos are designed to do. So, so the first thing I've got loaded up for Disney here, if you go to Disney's investor relations website, which, again, for any business that you might be interested in investing in. If you're going to be looking at a company or you want to put some of your hard-earned capital to work with a business, you should be pulling up their investor relations site, because that contains generally years or sometimes even decades worth of financial information for a company. What they've been doing in terms of revenue and profit and their debt and everything else. It contains all kinds of press releases on what's going on with the business. I mean, I personally think it's kind of exciting. Some people might find it pretty dry. It just depends on where you're coming from as a person, but nonetheless, you should be doing some research. There was this famous speech I actually watched a while ago, and the speech was by Peter Lynch, and I spent an hour in front of this crowd, I think out in Boston. And Peter Lynch, of course, ran the Magellan Fund for many, many years for Fidelity, and he's one of the most successful and widely known investors of all time. And he had kind of brought up what I'm talking about here as far as research and kind of looking at companies and pulling up annual reports and actually looking at what the business does instead of just pulling up some stock ticker or something or reading an article and just putting money to work. You should actually be doing the homework. And he said that he kind of expounded on how he finds it funny that people will, if they're buying a car or an appliance or something, they'll ask their parents, they'll ask their friends and their neighbors, hey, what do you think about these cars, or what do you think about this, or what do you think about that? And they'll do, they'll look up Consumer Reports and they'll look up all these, releases about this and all kinds of articles or whatever, and so they'll do all kinds of homework on, let's say, a car. They'll try to find all the information they can on recalls and this and that. But then when it comes time to invest in a stock, they might hear some kind of stock tip or something from some coworker, or they'll see something on CNBC and they'll just throw $5 grand or something at it. And so you don't want to think about investing like that. You can certainly do that. I don't know if I'd call it investing, but if you really want to think about long-term, successful, intelligent investing, you should be doing the research. So when you pull up Disney's investor relations site, you scroll a little down. Disney's investor relations site is actually one of the better ones out there. Some can be kind of convoluted, a little complicated, and some of the information is pretty buried, but with this one, you scroll down a little bit, you got all the annual reports right here, and you can even view more. So this goes back all the way from 2016, the most recent one for the last fiscal year, all the way back to 2005, and you can go back further if you'd like. But with we're going back more than 10 years here already, And again, as I've talked about in prior videos, I consider 10 years a pretty good proxy for the long term. Generally 10 years, if a company has a pretty good track record over 10 years, it's a pretty good, pretty good measuring stick as far as, what a company's doing, what you think they're going to do going forward, so on and so forth. So I've already pulled up the two, pertinent annual reports, which is 2016's and 2007's, which is a 10-year snapshot. So when I wrote the article on Disney, when I write any of these articles, I always look at 10 years of information, and as we'll show here in a little bit here, I look at 10 years of top line and bottom line growth, and you can see here fiscal years 2007 to fiscal year 2016 in the article. So you can see, so where I'm getting my information from when I pull up that 10 years worth of information, I'm getting it from the two annual reports that I've got pulled up here. And Disney is, before we get into kind of some of the numbers here, I just want to quickly talk about Disney, as I kind of talked a little bit about in the article. Disney's, there's a handful of really, really amazing, wonderful companies in the world. I mean, that term wonderful, that can get kind of bandied about and thrown about, and maybe it loses its meaning a little bit. And I certainly use the word a lot, but I try to use the word when it's appropriate. And there are a handful of companies out there that truly deserve, to be termed wonderful. I think Disney's one of them. You can put a few other companies in that basket. Let's say like a Nike, which is one of the companies I recently wrote about. You can put in a Johnson & Johnson in there. There are a few companies in the world that really have a certain almost tangible attachment for people. And when people think about Disney, when they think about their movies and their characters and their parks and all the different media that they have and all the different platforms that they have access to, people actually have a connection with Disney. There are a lot of people out there that spend a lot of money to go to their parks, to go to Disney World or Disneyland or wherever, and they'll spend a lot of money to go there once a year or twice a year or 3 times a year, and they'll do that every year. And I'm not saying anything good or bad about that. I personally, even though I live in Florida, I only live a couple hours away from Disney World. I live on the west coast of Florida. I don't really go there very often. I don't really go to theme parks too much. But that said, I mean, I can appreciate how people enjoy them and have an attachment to them. Apple is another example of that, where people use the iPhone. They have a tangible physical connection to Apple. And Disney is one of those companies where you actually kind of almost reach out and touch the business almost daily for some people. And these characters, they start to become part of people's lives. And I think that, when you think about long-term investing and you think about companies that kind of transcend time and generations and all the technology changes that happen in the world, Disney's one of those few companies that kind of transcend all that. And that's what, for me, makes them a wonderful business. And I think I probably used that term in the article a couple times, and I think Disney, deserves it. But anyways, Disney, they have a couple different segments. They have the media networks, which includes, which is a major part of the business, about half the business. That includes ESPN, of course, which is kind of the crown jewel of the company, if you will. And that also includes the major network ABC, which is one of the 4 major broadcasting networks in the United States, and they have a number of affiliate networks as well. And then, of course, you have the theme parks, which would include Disney World, Disneyland, Shanghai Disney Resort, Disneyland Paris. You have some cruise ships in there as well. And then, of course, you have the movie franchises, which includes, they recently bought Lucasfilm, so that includes all the Star Wars, that universe. They, of course, a number of years ago picked up the Marvel universe as well of films, so they've been producing, the Avengers movies and Captain America, so on and so forth. They've got a very successful cartoon and animation line, which includes, Frozen, Zootopia. Just an incredible company. And what I think is really fantastic about Disney, which there are very few companies that really kind of align their business just right to be able to do this, but all their platforms work together. So when they release a movie, let's say they release when they bought Lucasfilm and they're doing the Star Wars films, when they do that film then translates into video games and TV shows and cartoons and toys and T-shirts and all kinds of licensing opportunities. So when they do one thing, they're actually doing many, many, many things with that one thing. So they take one property, one media property they have, and really take advantage of it and kind of extrapolate that out into potentially hundreds or thousands of different opportunities for the company. So they really squeeze every possible bit of juice out of that lemon, if you will, which a lot of companies leave a lot on the table, but Disney, I mean, I'm telling you, they take one property and they really make the most of it. So I basically lay out kind of what the company is, what it does. Walt Disney, together with its subsidiaries, operates as a global diversified media and entertainment conglomerate. And again, that's kind of what they do. So they have the media networks, the television, of course, they have the cable, they have the movies, they have the theme parks, and they also obviously have all the licensing and everything else I just mentioned. So that's kind of basically what the company does. And then I go into and talk about the dividend a little bit here, and where I get this information from is, as I talked about in the prior videos, I pull up David Fish's Dividend Champions, Contenders, and Challengers list, which David Fish is this resource is invaluable, and dividend growth investors, I think we all appreciate the work that he puts into this. This guy basically compiles all this information into this one resource, and so he tracks all the U.S. listed stocks with at least 5 consecutive years of dividend increases. And right now there's 826 stocks on that list that you can choose from to invest in if you're a dividend growth investor. So you've got your dividend champions, stocks that have increased their dividends for at least the last 25 consecutive plus years. Dividend contenders 10 to 24, challengers 5 to 9. So when I pull up Disney, I basically just search for the company when I'm writing the article, drop down to Disney right here. You can see Walt Disney Company, the ticker, then you see all the dividend information right here. And you've got 7 years of consecutive dividend growth. And that's kind of a little bit of a blemish against the resume, I guess. They held their dividend static for a few years during the Great Recession. So, some people hold that against them. They were being prudent. They didn't cut the dividend or anything during that time period, which, there were a lot of companies that did, especially in the financial space, and Disney didn't. That speaks to, again, that kind of everlasting quality that I spoke about earlier. That speaks to the quality of the business. But, I don't hold it against him. I mean, had I been invested in Disney back then, I probably would have been bummed out to not get an increase. But, at the time, I probably would have had a large portfolio and I would have seen some other stocks cutting or eliminating dividends. So, you got to put that in perspective. Nonetheless, 7 consecutive years of dividend increases is what you have for Disney, as I put down right here. And then I go through the dividend metrics, which includes the dividend growth rate, the payout ratio, and the yield and everything else. And again, you see here, you see their 10-year dividend growth rate, which even includes that static period at 18.8%. And you see an acceleration because they did hold it static for a few years and then started increasing it again very aggressively to kind of make up for lost time. So you see that 18.8% over 10 years, but then over 5 years you see 30.1%, which is probably a little more applicable for our purposes because we're looking at, the actual dividend increases that have happened since the dividend was held static, which again is going on 7 years strong. So 30.1% is your most recent kind of growth rate that you have, which is over 5 years, which is 5 out of 7, basically a significant portion of the actual time period that you have to work with. So I include that information in the article, 30.1% dividend growth for the last 5 years, which is obviously huge. I wouldn't expect that to continue. Some of that, again, is making up for lost time. Looking at the most recent increase at 10%, that's probably on the low end for what I'd expect for Disney, but low double-digit dividend growth, as we'll kind of get into as we do this video, would be more near-term expectations, and then you'd want to scale that down when you're looking out over the very long term. But overall, I mean, 30.1% 5-year dividend growth rate, that's one of the higher rates you're going to find anywhere out there. And when I say that, that 10% dividend increase, this most recent one, is probably a little on the low end or a little disappointing. Their payout ratio, which is basically the amount of dividend they're paying out against the earnings per share. So what percentage of profit they're paying out directly to shareholders as a dividend, we're talking 27.2%, which, you can go to Google Finance, or you can go to the most recent, add up the most recent 4 last press releases for earnings and look it up. But this Google Finance number 5.74 is pretty accurate. You've got the dividend right now at 78 cents, which I'm going to have to refresh my memory here and just make sure it's a whole number. Yeah, it's a whole number. So we got 78 cents. It's a biannual dividend right now, so $1.56 divided by 574 is trailing 12 months earnings per share, TTM EPS. You got 27.2% right there, which is what I have right here. So, they're paying out basically approximately a quarter of their earnings in the form of a dividend, which is on the low end. I wouldn't mind seeing that payout ratio kind of creep up a little bit, which would imply a rather aggressive dividend growth rate, which would exceed earnings per share temporarily until the payout ratio kind of expands a little bit. As I've said many times, as I've written about, as I've said on these videos, I consider a payout ratio of 50% a pretty harmonious payout ratio. I consider it kind of almost perfect, because it sets aside half the company's profit for dividends to go back to shareholders, so shareholders can do what they want with that money and reinvest it at an appealing rate or pay bills or whatever. It's their rightful share to a company's profit. And then if they're paying out half, that means they're retaining half of the earnings. So they're retaining half of the company profit to reinvest back into the business, to continue growing at an attractive rate, take on opportunities, M&A, or what have you. So when a company takes too much money, when it keeps too much money, let's say it doesn't pay any dividend at all, that gives the company a lot of fodder. It gives the company a lot of money to kind of play with and potentially waste. If the payout ratio is too high and the company is paying too much of a dividend, that increases the risk of a dividend cut or elimination, and it also limits opportunities for the company. So you always got to kind of, it's a spectrum there, and you want to. I think you want to be somewhere in the middle. That way, it allows maximum flexibility for both shareholders and the company. We're at a quarter right there. So there's definitely some room for expansion there from Disney. And again, partly that is partly low because of that static dividend I spoke about. But again, they have been increasing it pretty aggressively over the last few years. They also moved from an annual dividend to a biannual dividend. So there's definitely been some improvement there in terms of the dividend. So if you're a dividend growth investor, Disney might not have been as attractive maybe 5 or 6 years ago, coming off of, the static dividend and a very low payout ratio and what have you. But, and also, some recent acquisitions like Lucasfilm and Marvel Universe and everything else. The company's just overall far more attractive today than probably 5 or 6 years ago. So in terms of dividend metrics, I think it's definitely getting there. The only real issue with Disney, again, partly related to this low payout ratio, is the yield. It was 1.44% when I wrote the article. We're at 1.48% right now, so it's pretty much the same as it was back then. It's not a lot of income. I mean, I typically look for stocks yielding at least 3%, because, when you're only yielding 1.5%, we'll call it, not a lot of income coming from that stock. So if you need that dividend, if you need that income to kind of pay current bills, if you need a little bit more income today versus tomorrow, then, Disney kind of loses its luster a little bit. Disney's in the same boat as like a Nike or a Starbucks, where you've got that kind of low yield and high growth rate. So I'm kind of a unique investor because I'm young, so I have the opportunity to invest in a Disney and allow that dividend to continue growing and kind of continue maturing and just kind of keep that thing cooking a little bit for many, many years. I have a very long runway for income consideration. So, I'm 35 years old. So, if Disney continues growing its dividend for 30, 40 years, I mean, the aggregate income could be substantial. And by the time I really, really need that income down the road, it should be, pretty strong for me. However, also being 35, I've been recently collecting my dividend income to disperse, to pay bills, and to give away through philanthropy. So I have to think about the Jason of today and the Jason of 20 or 30 years from now, and I kind of have to balance that a little bit. I think everybody does to a degree, but my situation is maybe a little more unique, where even though I am still fairly young, I do look for yield. I do appreciate yields, like I said, of higher, 3% or higher, because of my, I don't have a day job. I have my investment income, and I write, and that's where I get my money. So my dividend income is very, very important to me, and So, when a stock's only yielding 1.5%, that does limit my enthusiasm for that investment. That said, Disney, I do own Disney. I do have shares in Disney. I think it's a wonderful business. I give them the benefit of the doubt with that dividend, and I'm hoping that, bird in the hand, two in the bush. I'm hoping that, there's maybe 3 or 4 in the bush. I'm hoping that, Disney continues to grow its dividend at a very high rate. Again, low double digits, at least for, the foreseeable future. And that way my aggregate income, adds up over time. So, but again, if you're, if I were 55 years old, if I were 60 years old, Disney probably wouldn't even be on my radar. If I'm 20 years old, 25 years old, 30 years old, I think you could do a lot worse than Disney. I mean, I think Disney should be, one of your top ideas really right now, especially with the valuation as we'll get into. But in terms of quality of the business, brand name, everything, you name it, if you're a young investor and you don't need that income right now, I think Disney's one of the better long-term opportunities out there right now. So the yield 1.5%. When I talk about the valuation, I have, at Morningstar, as we talked about in the prior videos, I use their valuation tab to compare the current valuation metrics to the recent historical average, which is a 5-year average for everything but price to cash flow. So when you look at their 5-year average yield, you're at 1.3%. So Disney has historically, at least recent historically, and I think if you go back a long time, it never yielded very much. But over the last 5 years, the average is 1.3%. They're currently almost 1.5%. So, you've got a little bit of a spread there, almost 20 basis points compared to where their 5-year average is. So what that tells you is it's historically a low yielding stock. It's still a low yielding stock, but it's yielding a little more than it has over the last 5 years on average. So you're getting a little bit more bang for your buck right now. And that kind of lends its, that kind of leads into the valuation, into the undervaluation thesis that, we go through as this video goes on and as the article goes on. So those are the dividend metrics. Again, you've got that short dividend growth track record, but Disney's been paying a dividend for many, many, many years. The Great Recession, the financial crisis kind of put the skids on that temporarily. They're picking right back, up where they left off. The dividend's growing at a very attractive rate, very low payout ratio, which means that there's plenty of room, plenty of runway for continued dividend growth. The yield's a little low though, so again, depending on your age, depending on your income needs, what you're looking at for growth versus income, because there's always that dynamic between yield and growth. Very rarely will you find a stock that yields 5, 6, 7% and then gives you double-digit growth on top of it. As one rises or falls, the other one is inversely correlated generally. The higher the yield, the lower the growth. The lower the yield, the higher the growth. So they work opposite of one another, generally speaking. So it just depends on which one you need more of. I tend to average these stocks out. I have more than 100 different stocks in my portfolio, which I link to in all the articles. You can find it up at the beginning of the article. You can find right here. If you click that, it goes to my portfolio. You can also find it on the Dividend Growth Investing tab. My portfolio is right here. I own, I clicked on a link there. I didn't mean to do that. I own more than 100 different businesses. And I blend them out. So I have some higher yielding stocks like some real estate investment trusts. I own a little bit of a business development company, and telecommunications firms like AT&T and Verizon. So I get that 4, 5, 6, 7% yield on one hand, which gives me a little bit of room to play with the Disneys and Starbucks of the world. So that's kind of where I'm at with it. And again, what you do is totally up to you. But I think unless you're an older investor nearing retirement, Disney's pretty appealing as a long-term investment. So the next thing I get into is obviously growth for the company. I look at top line and bottom line growth over the last 10 years, and then I compare that to a near-term forecast by S&P Capital IQ. Blended together, kind of combining those two numbers, gives me an idea in terms of true earnings power for a company and where I think they're going to go moving forward. So the first thing I'm looking at is top line growth over the last 10 years, which is why I have those 2 annual reports pulled up. So I'm looking at revenue growth and I'm looking at earnings per share growth, which we'll go over, and you'll see where I got these numbers from. You can see increased revenue from $35.5 billion to $55.6 billion over the fiscal year 2007 to 2016 period. So it's a 10-year period, and you get your compound annual growth rate here. And before I do that, I have the 2016 annual report pulled up. I just want to address something pretty quickly here. A lot of investors are really concerned about ESPN and, because the media networks, which is what ESPN is under that segment here. They have their different segments here. Media networks, which is your ESPN and your affiliates, your broadcasting. You got your parks and resorts, which is your Disney World, your Disneyland, your Shanghai Disney Resort, your studio entertainment, which is your movies, and then you got your consumer products and interactive media, which is, again, all the licensing opportunities and things like that, toys. So they break down their segments, and you got your operating income right here, and it tells you, where Disney's at with all these segments. And you see here, Media Networks pops out right away, right? I mean, 7.7 billion, almost 7.8 billion of that 15.7 number here is Media Networks. And so when you look at that, and as I spoke about earlier, with ESPN being kind of the crown jewel of the company, that's concerning because a lot of people are cutting cable. ESPN's, Disney's been able to make a lot of money through ESPN for a long time because it's generally an automatic channel in most cable packages. And so people don't blink an eye when they have ESPN, even if they maybe don't watch sports. So ESPN's wrapped up into these expensive cable packages. Well, cable's now moving to a different business model where people are cutting the cord. They're moving to a la carte, over the top, and things like that, where they're a bit more selective in terms of their channels. So as that happens, that's obviously going to squeeze Disney a little bit in terms of their opportunities to sell ESPN, potentially margins in terms of what they can get for the channel, so on and so forth. The flip side of that coin is that, live sports, I was just reading something the other day about, the NBA finals, racking up the most, the most viewers since I think the last year of Jordan's, Bulls run back in 1996 or something like that. So live sport, and of course the Cubs, when they won the World Series last year, live sports have never been more popular. I'll just put it that way. I mean, people love live sports. They're willing to pay for live sports. They're willing to pay a lot of money to go watch sports in person. They love watching sports at home with the big screen TVs and everything else. So ESPN isn't going anywhere. Its business model might change, yes, and they've kind of addressed that. They've talked about some over-the-top opportunities and kind of moving it into a more a la carte type business model. That all said, I think it's important to keep one thing in perspective here. Disney is slowly but surely becoming less reliant on ESPN anyway, in general. ESPN used to make up a larger part of the company's overall operating income. And I'll kind of show you how that works here, and that's why I have this pulled up here. On the 2016 annual report, you can see their segment. They break down the operating income here on page 68, which is just below some of the financial statements we're going to get into. You see here, they break down the operating income, and I'm going to kind of go through some numbers for you so you can see where I'm coming from. Keep in mind, too, that Media Networks includes, your broadcasting and affiliate and your overall cable network. So ESPN is not this whole number. The 7,755, about $1 billion of that is just broadcasting. Then you'd have to peel some of that back on terms of overall cable networks and affiliates and everything else. So, at least $1 billion of it is broadcasting, which would bring that number down even further. But even let's just look at Media Networks as a whole, so you can kind of see where I'm coming from here. So, most recent year, 2016, we got 7,755 divided by 15,721. So I'm taking this number, dividing by this number, so you can see, what Media Networks is as a whole of total segment operating income. So Media Networks makes up about half the company's operating income, right? 49.3%. If you go back just a couple of years here, 2014, you can see they, obviously they break it down every year for you. And we'll just go through the numbers and see where they were at just a couple of years ago. 7321 divided by 13,005. You were at 56%. So you see, and if you go back further, you'll see that this number has been kind of slowly but surely dropping over time. So they're becoming less reliant on the media networks in general, of which ESPN has rolled into that, and of which ESPN does not make up the whole of the number. Again, about $1 billion of the 7,755 is just broadcasting. So if we take that away and divide that number out, you're at 42%, and ESPN isn't even this whole 42%. So, I don't know if they break it down any further than that. I'd be willing to bet it's probably somewhere around 35% of the company, which is still significant. Don't get me wrong, but when you see these other numbers growing, parks and resorts and studio entertainment and the consumer side, you see these numbers growing, but you see the media networks almost flat. So Disney's growing, but not due to media networks. They're growing due to their prowess with making movies, with building out parks, with creating these experiences for people, through selling toys and licensing and things like that. So that's what's really growing for Disney, and that's what's really propelling the company, not so much ESPN and stuff like that. So I think it's something to be concerned about, but I think when you read headlines and, ESPN subscribers fall and, Disney's doomed, you have to be kind of a little careful and keep perspective with that. So I just want to talk about that real quick. But we'll get into the main numbers here as it pertains to the article. I'm going to scroll back up to the financial statements here, which the first one is a consolidated statements of income. And I think I have it pulled up for 2007. I do. So, okay, so here we go, guys. So we've got 2007. We've got revenue at 35.5 billion, 35,510, and you'll see that should match up with what I've got in the article, 35,510. You see where I got that number from, right? 35,510 is revenue for that fiscal year. And most recent fiscal year revenue, 55,632, total revenue, total sales, total revenue, same thing. And you should see the same number, 55,632, 55,632. You see it all match up. So that's where I'm getting my numbers from. I pull up the 2 annual reports. I'm looking at the most recent financial data. I'm looking at the revenue. And then I want to know, at what rate compounded is the company growing its top line, its revenue. So I basically take those 2 numbers, which again is 35,510 and 55,632. Was it 55,632? Yep. And I'm using Investopedia's compound annual growth rate calculator. You can use any compound annual growth rate calculator you choose. I use Investopedia's, but they all work the same. So whatever you prefer to use. And then when you're looking at the number of periods, you're using 9, of course, because the first number isn't a growth rate, isn't a growth period. It's the starting point. So we got to look at over 9 periods there. So revenue is growing at just over 5% annual compounded clip, which I should have in the article, 5.11%. You see that matchup right there. So, mid-single digit compound growth for a pretty mature company is pretty good, actually. That's generally about what I look for. I look for anywhere from about 3 to 7% on a lot of companies that I invest in that are mature large cap businesses. The smaller the company, the higher the growth rate that I'd be looking for, generally speaking. But with a pretty mature company like Disney, growing its top line at 5%, that gives opportunities for excess bottom line growth when you take a look at maybe perhaps margin expansion and share buybacks and things like that. And that's exactly what happened. You see the bottom line grew at 11% compounded annually, and I'll show you where I got that number from. When you go into diluted earnings per share, you see diluted earnings per share 225 right here, which should match up on the article. You see right here 225, and most recent is 573. And you see earnings per share attributable to Disney, diluted, 573. So there's where I got those 2 numbers from. And when you compound them out, you got 225 to 573. And you see a 10.95% compound annual growth rate, which I laid out right here. And then I talk about what happened there between the two, because the compound growth for the bottom line is about twice as high as the top line. And what happened here is they improved their margins, and they also bought back a lot of stock. And you can see that. You can also see it when you go into you can see the weighted average number of shares outstanding right here. And as I talked about in the prior videos, Morningstar is pretty good at aggregating data, and they should be pretty good here. Yeah, so 225, 573, 35,510, 55,632. So you can see Morningstar is dead on with their aggregation here when they pull these numbers out. And you can see the shares right here too. You see the shares fall from 2092 to 1639. So they bought back a considerable number of shares over this period of time. And you can see here, you see that right there, 1639, which Morningstar has, 1639. So you can just take these 2 numbers here, and it'll tell you at what rate they bought back their shares. So you see the number of shares outstanding, 2092, minus the 1639. Divide that by the starting number, and you've got over 20%, which I should have laid out in the article. Outstanding share count is down by just over 23%. I don't know where I got that number from, guys. I might have messed up on that. I'm sorry. Let me do that again. 2092 minus 1639. Yeah, I'm sorry, guys. So, I do these videos and I keep myself accountable. I don't know where I got 23%. I must have looked at something else. But so keep myself honest. You can see I actually rounded that up an extra percent. It's actually 22%, not 23. So margins are up too, and you can kind of see that when Morningstar aggregates their data down here. You can see their margins. You can see an expansion here. You see 13, 11, 9, 10, 11, and then you see it zoom up. 13, 13, 15, 15, 16. And, they've brought on a lot of properties over the last decade. Iger was a wonderful CEO. He's going to stand a little longer than he originally planned on, which I think is great news for Disney and its shareholders. They've really just become a better company overall. So again, when you hear those headlines about ESPN and this and that, and they're having all these problems, keep in mind that Disney's becoming a better business. They're becoming less reliant on their media networks. They're becoming bigger and better overall. A lot of the growth opportunities are coming from parks and the movies and things like that, not so much ESPN. And margins are expanding. Their profitability has expanded pretty considerably over the last 10 years. And when you look at net margin's a pretty easy number to get. You basically just take net income divided by net sales and multiply it by 100 to get your percentage. So net income was let's see here. You got 40. I'm sorry, that's the older one. So you got 97.90 is net income divided by the revenue 55,632 times 100 gives you your percentage 17.6%. We'll call it. They came out 16.88. Let me just make sure I did that right. Net income. I'm sorry, 93.91. Did I look up the wrong number here? Yeah, I did. I didn't include the non-controlling interest here. So 93.91, guys. Sorry about that. So 93.91 divided by total revenue, which is 55,632 times 100 is 16.88%. So thanks for correcting me, Morningstar. If you go back down, 16.88%. Yeah, I figured I was probably wrong on that. They're generally pretty accurate for their numbers. So, and when I do the articles, I actually look at a 5-year average, which I get from S&P Capital IQ, which should be the same if you add these numbers up and average it out, but again, you see that acceleration there. Most recent year came in at almost 17% compared to 13 a decade ago, and you see they were kind of middling there, just barely in the double digits. And now they're firmly in the mid double digits right here. So definitely an improvement overall. So that explains that excess bottom line growth here when you look at revenue and earnings per share growth right here. So you got 5.11%, almost 11% earnings per share growth. Now, when we look at, when we want to value a business and we want to kind of consider, okay, what do we think its dividend growth is going to be going forward? We have to consider its payout ratio. Is there room for expansion, or is it too high already? We have to look at, where they've been at over the last 10 years in terms of earnings per share growth and how that'll impact dividend growth. How fast the dividend's already been growing, what's the demonstrated long-term dividend growth rate, and then also what we think the company's going to do going forward, because we're not investing in where a company's at, we're investing in where a company's going. We're not investing where a company's been 5-10 years ago. What Disney did 10 years ago doesn't really matter for my dollar today. It matters where they're going to be 10 years from now. So we have to look at kind of where we think they're going to go moving forward, and that's why I use S&P Capital IQs. They kind of forecast out future earnings growth right here, if it pulls up. So we've got their future earnings, their 3-year projected EPS compound annual growth rate at 9%, which I should have reflected in the article, which you see right here. EPS, they expect Disney to compound its earnings per share at an annual rate of 9% over the next 3 years. So that's where I got that number from. It's right here at the top right. Quality ranking A+. Again, you're not going to get much better than Disney there. So yeah, so what we're saying here, what S&P Capital IQ is saying, I'm just kind of repeating what they're saying. They believe that Disney's growth is going to, roughly match what they've done over the last 10 years. I mean, there's a slowdown there, and they kind of talk about that. Conversely, we note the company's high vulnerability to a slowdown in consumer spending. It's a relatively high exposure to capital-intensive theme parks. So there's a little bit of a drop-off from what they did over the last 10 years there. Certainly, the risks with ESPN and what happens with cable may impact that a little bit. The good news, like I said before, though, is it's that, their films, their parks, their products, their licensing, their toys, that's what's really growing Disney. That's what's actually moving the dial, not really their media network so much. And not only that, but the broadcasting, the affiliates, the other networks, that's all still pretty strong. I mean, people, if people cut the cord, they're still watching ABC and NBC and CBS and stuff like that. So, I see that risk mitigated somewhat, but it is something to consider. So when I look at that, I say, okay, well, they've grown at 11% over the last 10 years, compounded out. The compound forecast looking out over the near term is 9%. If you want to kind of average that out, kind of meet in the middle, you're looking at about a 10% growth rate moving forward if we want to expect that over the near term. And that, again, with that low payout ratio of only 25%, which could certainly be expanded considerably, that supports a thesis or a base case for low double-digit dividend growth moving forward. Because if the earnings per share are growing at 10%, let's say, and the dividend's been growing at double digits, the most recent dividend increase was 10%, the payout ratio is at 25%, Disney could grow its dividend 12, 13, 14% for many, 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 many years, and be expanding that payout ratio just slightly because earnings per share is coming in at almost, what we're thinking, maybe 10% or so. So, that makes a case for pretty strong dividend growth moving forward, which, I think, again, 10% even would be pretty disappointing because that's basically just right in line with earnings per share growth, which would mean the payout ratio isn't expanding at all. So that's kind of where I'm getting some of my numbers from. I even talk about the ESPN noise. Disney's chugging along, which, again, as I talked about prior, that's that kind of idea supported by, when you look at the overall growth of the company at 11%, Media Network's staying pretty flat. You see all the growth. You see where the growth is coming from, which is, again, in the parks, in the movies, in the toys and products and things like that. So the other fundamentals we look at, obviously, in these articles, which, again, as I've kind of covered before with what I've been talking about in these videos, these articles are basically a high-level look at a company's fundamentals. It's more of a quantitative analysis than anything else. I don't really get into, I don't really get into too much qualitative stuff with these articles because qualitative analysis is highly subjective. I mean, one investor could say one thing about a company's, qualitative aspects. Another investor could say something totally different. But you can't say anything different than I have with the fundamentals. I mean, you can't come in and say, well, the earnings growth rate isn't this. Well, the revenue growth rate isn't that. Well, ESPN doesn't make up that percentage of the company. There's nothing really to debate there. These are hard numbers, and I like that because when you have a conclusion at the end, it's supported by firm numbers. It's not, well, I think Disney might do this, and the quality of the company, over here is maybe that, and with the CEO doing this, that's all kind of in the peripheral of a business. The fundamentals are really the core of a company. I mean, where is its revenue? What is its profit? What is the dividend? What is the margin? What are we really talking about with the business? And when you break it down fundamentally, it gives you a picture that, can't be debated and is almost timeless, is almost everlasting. Qualitative analysis can very quickly change, even over a course of a few months. Quantitative analysis doesn't. This stuff is everlasting. It's pretty evergreen. So the other fundamentals I get into is obviously, first of all, the balance sheet, which for Disney, as I talk about in the article, I mean, just a very, very rock solid, very strong balance sheet, excellent balance sheet, long-term debt to equity ratio right here, and the interest coverage ratio right here, which I'll kind of show you where we got that from. If we scroll down to the balance sheet, you've got long-term debt, and the long-term debt to equity ratio, as I've talked about before, is, people consider that a bellwether for a company's overall leverage. I really don't place a lot of importance on long-term debt to equity because, like I've said before, equity can be massaged positively or negatively by a lot of things. It can be affected by a lot of things. I tend to look at, is a balance sheet stable? I look at the interest coverage ratio. I place a lot more importance on that because that tells me how much money's coming out. What percentage of a company's pre-tax income is being spent on interest expenses. How much is a company spending on interest expense relative to the money it's taking in? And it's just like if you were to take a look at your own income and expenses, say, well, I'm taking in $5,000 a month, but I got $1,000 in credit card bills. You would be concerned about that. But you could also spin it around and say, well, my overall debt compared to my assets isn't that high. Sure, maybe that's the case. Maybe because you're inflated your home value. You went on Zillow and your home value is inflated by 30% or something, and that can make some numbers look different. But when you're looking at actual cash in, cash out, I just consider that a more applicable number and more relevant and really something I can kind of work with. So, but when we look at long-term debt to equity, I still use it in the articles because it is such a popular kind of bellwether type of number, and it's something that people can kind of quickly look at and everything else. So what we're looking at when we're doing the long-term debt to equity ratio, we're basically looking at long-term debt divided by total shareholder equity. And S&P Capital IQ as well as Morningstar, they also break it down for you here. You see long-term debt, you see common equity right here. And when you pull up the annual report, you've got right here, you've got borrowings right here, and you've got equity, total equity right down here, and that should match up. Total Disney shareholders equity, 43,265. So yeah, you've got total Disney shareholder equity right here, 43,265. So when you divide the two numbers out, you've got 16,483, right? And you can see debt's up from the prior year. A little bit of a concern, but a lot of companies have taken on debt, over the last 5 to 10 years because interest rates have been so low, and that's something else I've talked about in prior videos. The other thing to keep in mind, as I mentioned earlier with that quick little note from S&P Capital IQ, and when you think about Disney, a lot of the businesses that they run are highly capital intensive, especially their parks. So there's a lot of investment necessary up front. For instance, Disney just invested like $1 billion or something to build out that Pandora world in Orlando. So when you're putting out $1 billion to do an addition on a park, that's a lot of money. That's a lot of capital outlay up front for hopefully increased revenue and profit down the line. So just something to keep in mind. Nonetheless, as I mentioned earlier, their balance sheet's outstanding. So when we take a look at those two numbers, we've got total long-term debt divided by shareholder equity. We've got a long-term debt to equity ratio of 0.38, which should match out in the article. You see right there. Interest coverage ratio is over 40. Really, and I talked about this a little bit before, and I'll kind of repeat myself. The interest coverage ratio again is I consider it more of a bellwether metric really than the long-term debt to equity ratio, because again, it's cash in against cash out. I start to kind of be concerned when that number's under 5, when you start getting into low single digits. Anything over 5 I think is acceptable. Anything over 10 is pretty good. And then when you start getting well over 10, you start getting well into the double digits here, 20, 30, 40, 50, 60, that's just an excellent balance sheet. At that point, you really have no concerns over a company's ability to cover its interest expenses. And where you get that number from is, you take, scroll up too far, you got to take income before income taxes and interest expenses divided by the interest expense. You're taking EBIT divided by the interest expense. So, income before income taxes, you see right here, 14,868. And then you got to add back in the interest expense because that was already taken off of that. That was already reduced. So interest expense right here is 260, which you can already see it's a very small portion. 260, you're talking almost 15 billion. It's peanuts, right? So we got 15,128 divided by the 260 interest expense. Okay, guys, so I had to pause real quick there and kind of take a look at what I was going through, because I wrote this article a few weeks ago. When I did the interest coverage ratio, I actually took the more conservative number. When you pull up S&P Capital IQ and Morningstar, what they actually list for the interest expense is 354 million, and what Disney lists down here is 260 million. When you pull the when you go further into the annual report, because I was a little confused about why there was a disagreement there in the numbers. Disney adds back in some investment income right there. So I went with the more conservative number. You can go either way with it, but when you add in that 14,868 and take away 354 million, I'm sorry, add 14,868, add back in your interest expense, 15,222 divided by the 354 million. You get an interest coverage ratio over 40. If you take the more the more aggressive number of 260 million, you get an interest coverage ratio over 50. Either way, either way you look at it, it's really peanuts for Disney. Their interest expense is almost nothing for the company. It's really nothing. They're getting EBIT over $15 billion. They could take on, they could double their interest expense. They could double it. They could triple it, and it wouldn't really even be a concern for Disney. So I have no concerns over the balance sheet, even though you have seen some deterioration there over the last couple of years or so with more long-term debt and whatnot. They have some capital intensive parts of the company, which certainly if you're kind of not a fan of Disney, you could kind of point to that and say, well, ESPN isn't so capital intensive, although it really is because they have to pay a lot of money for those sports rights. But you could say, well, the parks and some things that are growing are really capital intensive and it takes a lot of money to make these blockbuster movies. You got to spend money to make money, right? And you have to invest in a business, and that's why, again, you want that payout ratio, as I said earlier, to be closer to 50%. That allows a company maneuverability, not just in terms of taking on debt, but also retaining earnings and growing the business and so on and so forth. And that's maybe another thing that gives Disney a little bit more flexibility is that low payout ratio. They're retaining a lot of earnings to kind of grow the business and to take on certain acquisitions that they feel are going to be profitable, which they've done really well with that over the last few years or so, again, with Marvel and Lucasfilm. So they're doing just fine, but nonetheless, the balance sheet's in excellent condition here. And then the other thing I look at in terms of fundamentals here is return on equity and net margin. I consider net margin far more important than return on equity because, again, the equity portion can be kind of positively or negatively massaged for a company. And when you're looking at return on equity, it's basically just net income divided by shareholder equity. And, it's what you're earning on total shareholder equity. And, with shareholder equity itself being kind of like, not always all that accurate. I look at net margin because it actually tells me what percentage of a company's revenue drops down to the bottom line, and that's really what it comes down to. How many pennies can you get out of a dollar? That's really what's most important for me because that fuels everything else. It fuels reinvestment in the business. That fuels the dividend. That fuels everything. The more profit you can squeeze out of a dollar, the richer everyone else becomes. So, for shareholders and everything else. And when you get that 5-year average, I'm looking at this number right here, 5-year average, 15.06% and 17.17% right there, which should match up right here. You got 5-year ROE at 17.17, and you've got net margin average over the last 5 years at 15.06%, which again is an acceleration, as I spoke about earlier. We go back in the key ratios right here. You see the return on equity. You see the acceleration right here off the average. You're averaging 17.17. The average over the last 5 years, if you look at this, is probably closer to like 13, somewhere in that range. Net margin, same thing. It's going to be low double digits. They're probably averaging somewhere around 11 over the prior 5-year period. So definitely an acceleration there in terms of net margin return on equity. So fundamentals overall, really strong. Great balance sheet, robust profitability. You've got bottom line growth in the double digits for a mature company. That's pretty outstanding. They're buying back a lot of stock. There's really just not much to dislike about Disney. Again, there's a tangible relation to the company. People tangibly connect with Disney. And I once read, somebody kind of said that Disney, and I don't know if they attributed this to Warren Buffett or who it was, but somebody said that Disney has a monopoly on childhood, because they're making these movies for kids. They're making these cartoons, like Frozen and Zootopia and things like that, and they're basically just capturing the imagination of children. And these children grow into adults, and they always have that connection with Disney. So, and obviously as our population grows and as people give birth to new children, there's always that new generation, that new audience kind of built in for Disney, kind of coming up into the world. So I don't know who originally said that, but it's kind of a great insight into Disney, into what it does and everything else. And as the rest of the business grows, that's built on that foundation of kind of capturing that imagination and building that customer very early on in their life. I mean, very few companies are, getting a client at 3 years old or 2 years old or 4 years old. With the Disney Channel and everything else that they do, very few companies are saying we're gonna build a customer, we're gonna land this customer at 4 years old. Even if you're Coca-Cola, you're probably not doing that. So it's incredible that they're able to do that. So when we get into the valuation, that's the last part of the article. We first look at the PE ratio. I look at the PE ratio today against its recent historical average. Current PE ratio is 18.39. When I wrote the article, it's 18.85. So there's been so the stock has dropped just very slightly since I wrote the article. It's almost flat, but you've got a PE ratio in the 18s right here. When you compare that out to the last 5 years, as well as the broader market in general, you see a discount there. So price to earnings ratio, they have it at 18.2, which is low. It's actually a little higher than that right now. But nonetheless, the 5-year average is almost 20, guys. So there's definitely a discount today compared to where it was. I mean, it's a stock that's never really, extremely cheap. I mean, you're not going to see Disney with a PE ratio of like 12 or 13 because it's growing at a phenomenal rate and it's a wonderful business. But there's definitely a discount to the broader market as well as its own 5-year average. There's also a discount on cash flow. Current cash flow is 14 times. The 3-year average is 15.6. Excuse me for a sec. So there's definitely a discount, where you're getting Disney today compared to where you've been, recent historical average. Sales is roughly flat. Price to book is a little higher right now. Again, book value and things like that. Unless it's a bank or something, I don't really kind of look at that too much. I'm basically looking at, what's this company doing in terms of cash, today compared to where it's been, and what are investors paying for that cash. The other thing to look at is obviously current yield relative to recent historical yield. And I talked about that earlier being about 20 basis points higher than its recent historical average. You can see over here. So there appears to be a discount. It's not huge. Disney isn't, incredibly cheap. You're like in this massive discount like you might see in like the retail industry or something like that. But it is a little cheaper than it has been, and it's cheaper than the broader market. And I'd argue, and I think that a lot of people would agree with me, that Disney is higher quality than the broader market. It's a wonderful business. If you take a look at all 500 or so companies in the S&P 500, you're going to find a lot of unprofitable companies, and certainly businesses that don't have the household value, that brand name of Disney. So, if the average, broader market is over 21 times and Disney's coming in at under 19, I don't know. I think that's something to be aware of and pretty excited about, in my opinion. So I kind of talk about that right here, about it being, the PE ratio right now, price earnings ratio being lower than its recent historical average. The yields a little higher than its recent historical average. So investors are paying less for earnings today than they have been willing to pay on average over the last 5 years. And as a result, they're getting a little more yield. They're getting a little more current income for every dollar invested today. So, and then the next thing I do is basically do the dividend discount model analysis. And I talked in the prior video, actually the prior couple of videos, I talk about what I do with the dividend discount model analysis. So I don't want to repeat myself. I'll just quickly note that I used a 10% discount rate because the yield is low on Disney. If this yield were 4% or higher, I might back that down a little bit, but I'm using a higher discount rate, which again is, I think bakes in a margin of safety at 10% because that's just slightly higher than the long-term, compounding or growth rate of the broader market. So, you're baking in a slight margin of safety with that higher discount rate. So I factored in a 10% discount rate. I assumed a dividend growth rate of 18% for the first decade, which, again, might be a little on the high side, but when you look at what Disney's done, I don't know how I got down here. When you look at what Disney's done over the last 10 years, it's right in that range. And that's even with the dividend being held static for a few years. And they're still over 18%. The 5-year dividend growth rate has accelerated. That most recent dividend increase is a little disappointing to that broader thesis. But I think Disney definitely has the ability to grow its dividend, in that range over the next 10 years for sure. If they're going to grow the company at 10%, payout ratio at 25%, you could expand the payout ratio ever so slightly over the next 10 years and easily come out with a 15, 18, 20% dividend growth rate, year after year after year. So breaking that down, I use the dividend discount model. I just substitute dividends here. So we got the dividend, we got 78 cents, right? Biannually. And then I've got the 18% over the next 10 years. And I'm using a 2-stage dividend discount model analysis here, which I usually use a 1-stage, but I'm using a 2-stage, as I talked about in the article, because of the low yield, high growth rate. If you've got a company that is growing its dividend at 6, 7, 8%, and it's got a yield of 3% or so, I would use just a 1-stage dividend discount model analysis for that kind of stock, because you're not going to see this massive acceleration over 5 or 10 years and then see it drop off or something like that. It's just unlikely. Disney still has a very low payout ratio, again, partly because of that static dividend for a few years, and partly because it's just kind of, never paid out a massive dividend to investors. But again, with the underlying earnings growth rate, with that payout ratio still being so low because they're still kind of catching up a little bit, and with the historical demonstrated dividend growth, I think, I don't think my assumption is really too crazy here. I'm right in line with kind of where the company's been at. So, but I use a 2-stage because of that low yield, high growth dynamic. So I've got the 18% for the first 10 years. And then as I wrote about in the article, the long-term dividend growth rate or the terminal dividend growth rate is 7%, which, I consider that pretty reasonable too. I mean, there's a lot of companies out there like a Johnson & Johnson where, they've been growing their dividend for over 50 consecutive years and they're still growing it at 5, 6, 7, 8%. So it's not that hard to attain for a company, assuming that they continue to do brisk business, assuming that they can keep up their quality, continue to sell ever more product and services to ever more people around the world. I don't think that's a crazy expectation. And as I talked about in a prior video, although that terminal growth rate is technically forever, technically out, into infinity, after a certain point, it just becomes a rounding error, number one. And number two, I'm really more concerned with my lifetime. If Disney grows at this 7%, let's say they drop down and they grow at 7, 6, 7, 8% or something like that over the next 30, 40 years, and then things fall off the wagon, if I'm 80 years old, I don't know. I'm not too concerned about that. I'm not immortal. I'm not a vampire. I don't really worry about infinity. I'm really more worried about, when I think about these dividend growth rates, when I think about a terminal growth rate, I'm really thinking about 30, 40 years tops. I'm really not going out further than that. So, and again, I think that's reasonable when you look at a lot of companies out there that have been able to do that over a very long period of time. So I've got the terminal growth rate of 7%. I got my discount down here. I got my 7 right here. So when I calculate out the valuation, I get 135.70, which is listed right here. So you see the numbers match up right there, guys. And I talk a little bit about what the dividend discount model analysis is, which is basically just a tailored version of the discounted cash flow. And the discounted cash flow model analysis is kind of the gold standard for valuing businesses. I just use the dividend discount model because it's tailored for my intents and purposes for dividends and dividend growth. And that's really what I'm after. Is I'm after a dividend, I'm after a growing dividend, I'm after that income for reinvestment purposes at first, and then later to live off of the money. So as a dividend growth investor, that's what I'm most concerned with it being somewhat of a proxy for cash flow anyway, because a company can't pay dividend if it's not earning the cash flow. So if you have 30, 40, or 50 years of dividend growth, you're probably going to have 30, 40, 50 years of cash flow growth, right? Because you're not going to write checks you can't cash. So they work hand in hand. They complement one each other. I just think the dividend discount model analysis is a tailored version and more applicable for what I'm aiming for as a dividend growth investor. And then I compare my analysis to keep me honest and to kind of add value and perspective to these articles. I compare it to what Morningstar and S&P Capital IQ come up with, which you can see Morningstar, they rate it as a 4-star stock, which is right here. And then when you go over to Morningstar's research report, you get a 134 fair value estimate right there, which is right here, 134. S&P Capital IQ, they have their fair valuation at 115.70. They actually increased this since I last wrote the article. They now have it at 119.40. So they obviously updated this over the last probably few weeks or so, which they do. All these companies do. They revisit these stocks, generally every few weeks or maybe once a month. They increased it a little bit. So since I wrote this article, the valuation of Disney has obviously increased a little bit because I'd be averaging out that higher number, and the prices dropped just slightly. So that actually makes the stock even more appealing today than it was when I wrote the article. And they also listed as a 4-star buy, which let's see if they've updated that. Yeah, they still have it as a 4-star buy down here. So, okay. So if I were to average these numbers out, I'll actually update these numbers since we're doing this video today. So I've got my number at 135.70, which obviously hasn't changed. Morningstar hasn't changed. And S&P Capital IQ has changed. They have 119.40 now on the stock. So that gives us a fair value of 129.70. So, I don't know, change by a buck. I mean, you're still looking at the stock being over 20% undervalued right now because it's dropped ever so slightly. So it's roughly the same. Nonetheless, I mean, Morningstar came in at 134. I came in right about where Morningstar came in. The average valuation is coming in at 130. So you can kind of take a look at this, from a high level and say, Disney appears to be worth about 130 a share. You could say 125, you could say 127, you could say 130, but I think getting up to that 130 mark is probably pretty accurate for the valuation for what we're looking at. I mean, you can pull up other analyses and other valuation methods and see who else says what, but looking at everything and putting it all together, I think 130 is a pretty strong estimate for what Disney's probably worth today. So, that's where I got everything from, guys. I hope it helped to go through this. I apologize about the error there with the share buyback. I'm not sure what I was looking at. I might have been looking at maybe its most recent number instead of the last fiscal year. But overall, you can see where I came up with everything. And that's what we're trying to do with these videos is keep these articles honest. You see where I'm coming up with these numbers. I'm not kind of making these up out of just off the top of my head. I'm getting these numbers from annual reports. I'm looking at aggregated data from professional research companies. I'm looking at what Morningstar is coming up with on their valuation, what S&P Capital IQ is coming up with their valuation analysis. I combine my valuation with their valuations, and that way you can again, it's all just designed to add perspective, add value, keep this conversation moving, and so you're not just getting one voice, you're getting multiple voices, you're comparing multiple methodologies together, and you're getting a final valuation on a high quality dividend growth stock. And this is basically just we're just trying to add value for you readers. These are actionable real-time ideas. These are high quality companies that appear to be trading at appealing valuations. Sometimes some of these stocks I write about are only maybe 5 or 10% undervalued. Sometimes they're 20% or more. With Disney trading at perhaps 20% or more, discount to its intrinsic value, I think that's a pretty strong long-term investment candidate. I mean, the one potential issue, especially if you're an older investor, would be that yield. So, if you're 55, 60, 65 years old, maybe Disney doesn't make a lot of sense. Maybe, real estate investment trusts, telecommunications, companies, that offer, yields of 4, 5, 6% might make a little more sense because you're going to be living off of that income very soon. Disney might not fit in that universe. But if you're 25, 30 years old, 35 years old, 40, I think Disney, and if it's in a highly well-diversified, broadly diversified portfolio that also has a lot of stocks that offer that kind of higher kicker for income now, when you average that out, if you're able to get a yield of 3, 3.5, 4% across your entire portfolio, I think Disney, man, I think it makes a lot of sense. Some of my best investments, if you're just looking at total return, mostly on the capital gain side, obviously, when we're talking about low yield stocks, some of my best investments have been these stocks that offer lower yields, like a Visa and stuff like that. So, it's just, you got to, think about where you're at, what you need, and then invest appropriately. But, if Disney's in your wheelhouse, I think right now is a pretty good time to take a very good look at Disney. And again, keeping in mind that those headlines over ESPN are probably a little overblown when you really look at what's growing Disney and where ESPN's at, and you look at where ESPN's at today relative to where it was at 2, 3, 4, 5, 10 years ago. So overall, I think Disney's a high quality dividend growth stock, and it appears to be undervalued right now, perhaps 20% or more. So I hope this video provided value for you guys. I hope it added to the conversation about Disney and where it's at today. I have fun doing these videos. I have fun writing these articles, and I'm just trying to provide my voice, lend my voice to the community, and provide a little value, and hopefully it keeps the conversation going. So I appreciate you guys watching today. Hope you guys have a wonderful day. Thank you so much. Bye-bye.